Is it too late to start investing here in 2023? I personally don't think so. And I actually don't think there has been a better time than right now in a very, very long time. The reason is that the market has dropped a lot in value, and that gives a lot of good investing opportunities. However, figuring out how to start investing can be really difficult and very overwhelming, and that is exactly why I've made today's video. I will be going over all of the things that I personally think that all new investors should know before they start investing. And that includes everything from the historical development of the market, what you can expect as an investor, and how you can develop your personal investing strategy. I will also be giving a few examples of investments that I think look really interesting right now. So let's start by talking about the historical development of the market. When you're looking at the historical development of the market as a new investor, well, then you could start to worry that we've already reached the top, or at least have been somewhat close to reaching the top. And figuring out whether the market is going to increase or decrease from that point is really difficult. If we are to analyze how the markets have developed over the last 40 to 50 years, then let's take a closer look at the S&P 500 index. This is basically an index that contains the 500 largest companies in the US based on market cap, and it is also the most popular index there is. So by investing into this index, you actually get a very small fraction of 500 different companies. But let's take a closer look at how this index has developed over time. Overall, it is pretty safe to say that having invested in the S&P 500 index a long time ago would have been a very good investment. However, there has still been some periods with significant economic losses, such as the crisis in the 30s, the oil crisis in the 70s, the dot-com bubble around year 2000, and of course at the Great Recession in 2007. Every time one of these events has happened, there has been significant losses in the stock market. However, when looking at the broad picture, it is very clear that the market has always recovered and reached an all-new time high. And the average yearly return for the S&P 500 index during the last 90 years is actually 9%. At a 9% rate of return per year, if you then invested $500 per month for 40 years, then you would end up having more than $2 million. So before you buy your first stock, then there are certain things that you need to have thought about. The first thing that I would highly recommend is to get an overview of your financials. Make a budget and find out how much you can actually afford to invest. The next thing is then to have an emergency fund, just in case something goes wrong, then you always have money available. I personally have an emergency fund that can cover all of my expenses for the next 6 months if I were to lose all of my income. And anything I have above that amount, that is being invested. The next step is then to figure out how much you can invest. A good rule is to always invest money that you can afford to lose. In that way, you never end up investing money that you actually need for something else. However, the more you invest, the more you will end up earning. What I personally did was to invest 10% of my monthly income in the beginning, and that is a really good starting point for any new investor. When you have decided that you want to invest and the amount that you want to invest, then the next thing you need to do is look at the strategy. And this can be really difficult and very overwhelming for a lot of new investors. So let's break it down. The first thing that you need to do is to figure out why it is that you want to be investing. Is it to pay for your vacations, to buy new phones, buy new computers, or is it to build up your net worth and retire early? The next thing that you then need to do is to figure out how it is that you want to reach this goal. And there are several ways of doing it depending on what type of investor you are. You can either be an active or a passive investor, depending on how often you are investing and what you are investing into. The active investor is of course the investor that is trading the most, but he also has a more active approach in deciding what companies to invest in. The passive investor, on the other hand, is not trading that often, and he might only select a handful of companies that he wants to invest in. And then he places the rest of his money within broader indexes that contains a lot of different companies. I am personally the passive investor that likes to lean back and just let the markets do its thing. The next thing you should do is figure out when you want to reach your goal. However, the longer you stay invested for, the more you will end up earning and the lower the risk you will have. I am personally investing with money that I don't plan on using for the next 20 to 30 years at least. Short-term investing is, in my opinion, more like gambling than investing, as predicting what will happen within the next 2 years is very difficult. Just look at 2020 when COVID-19 came and made the world into lockdown. Not a lot of people would have predicted that in 2019. Now it is time to figure out how often you want to invest, and there are two general ways of doing it. The first option is to invest all of your money at once and then basically just let the money sit there and do its thing. The second way is to continuously invest into the market. This is what most people are doing, including myself. By doing this, you make sure to never invest all of your money just before the market is about to crash. And that reduces the risk of investing significantly. One of the last things you need to do, but also one of the most important things, is to decide how much risk you want to include in your portfolio. The higher the risk, the higher is the potential return, but the higher is your potential losses as well. I'm personally investing into lower risk assets, such as broad index fund or large companies with a lot of cash on hand. Companies like Apple, Coca-Cola, Disney, and Johnson & Johnson are all examples of really good low-risk investment opportunities. The last thing you need to do is, of course, to figure out what it is that you want to invest into. A really good starting point for the majority of new investors would be something like the S&P 500 index. That gives you the diversification benefits of having 500 companies in your portfolio. The S&P 500 index is a staple in my portfolio, and you don't find many investors who doesn't have the S&P 500 index in their portfolio. So I would highly recommend to start by investing into that if you are a new investor, and then figure out what kind of investor you are and base your portfolio around that. That was all I had in today's video. Thank you for watching the video, and if you actually liked the video, then please press the like button below the video and subscribe to my channel if you want to see more videos like this one in the future. Thank you for watching and see you in the next one.